Welcome to another episode of #IEA Isolation. I'm Emily Carver. Don't forget to comment, like, subscribe if you're new to the IEA channel. And also you can subscribe to our new IEA daily newsletter where you can keep up to date with all our new digital output. Today I'm delighted to be joined by a particularly illustrious panel. We've got Christian May, who is editor of City AM. We have Allie, Renison, who is the head of EU and trade policy at the Institute of Directors, and also Victoria Hewson, who is head of regulatory affairs at the IEA. Hello, everyone.
Hello.
Thanks for joining me. So, Christian, if I may start with you. You wrote an article a couple of weeks ago in City AM on the Chancellor's coronavirus business interruption loan scheme. You argued at the time that the scheme risks failing the people it was designed to help. I think a lot of people watching this don't really know the ins and outs of the scheme, really. Could you start maybe by explaining in layman's terms what the aims of the scheme were originally and what the offering was?
Yes, of course. I think the first thing to note is that since I wrote that article, quite a lot has changed, and that's a good thing, with a scheme like this. It's right that the Treasury and the lenders themselves who are participating adapt and change the way things work as problems become clear. But problems have been becoming clear for some time. So there's still some more changes that I think would help. But the way the scheme works is the Coronavirus Business Interruption Loan Scheme, known as CBILS. It's aimed at the SMEs, the mid-market. And it allows companies to apply for a loan through, I think now 60 or so accredited lenders, which range from quite specialist asset finance lenders right the way up to main high street banks. And it's aimed at companies with a turnover of, I think, up to about £40 million. That chunk of the SMEs, of which there are about 5 or 6 million in the UK, and the majority of which simply don't have enough cash to see them through this period where there is essentially zero economic activity. So the scheme was put into place very quickly, and I think some credit should be given to the way in which the Treasury and those original participating 40 or so lenders tried to get it off the ground. But there were some very obvious issues very early on, and the first was with the application process itself. Most lenders began to treat this as if it was a normal commercial loan application. And in the very early stages, that included trying to talk people into other forms of finance, and it included some lenders saying that individual directors would have to put up security, even the property they own. None of those things were envisaged in the way the scheme was originally designed. It was an extraordinary policy response to an extraordinary economic crisis. And if the government had tried to launch it in peacetime, there would have been a trial period, consultations, and you would have ironed out all sorts of problems. But of course, that wasn't the way it was implemented. So there were problems with the application process. There were problems with the way the banks treated the whole process. And important to remember also that for banks, they were being asked to do a great deal. They were being asked to use their own money to finance loans over 6 years on not particularly commercial terms. And although the government would underwrite 80% of that loan, it did put a lot of pressure on the banks, who were simply not allowed by law to issue bad loans. And so they were obviously cautious. Since then, quite a lot of changes have been put in place to try and free it up a bit. I think 66,000 companies have successfully applied. As of today, 33,000 have received a loan. So I don't think those numbers are particularly impressive, though I would give some credit for the way the scheme got off the ground very quickly, albeit with problems baked into it, some of which I'm sure we'll explore in this conversation.
Allie, do you share Christian's analysis there? What sort of feedback have you had from your members?
I'd say the feedback's been largely negative on CBILS. Having said that, it does need to be looked at in the context that Christian talks about. And I think we'll come back to this issue about the different systems that exist across Europe compared to the UK with pre-existing guarantee schemes for loans like this. So effectively, I think what Christian's talking about is we really had to set something up that other countries had a head start on, if you like, to a certain extent in terms of the interaction between sort of private lenders integrated into sort of state-backed guarantees and dispersals for businesses. It was interesting, actually, if you look at Ireland, Ireland had a Brexit loan scheme, even though they don't currently have a government, that had been a sort of state aid cleared facility, and that just morphed into a coronavirus loan facility. So they're one of the few countries alongside the UK that don't have pre-existing state development banks. So I think, just to stress Christian's point, that we were starting really from a different point of scratch from other countries. So the speed there is definitely an issue that should be put in context. I think that for a lot of directors, and I sort of clarify directors, I mean, you hear a lot of discussion about small business, and that's a word sort of thrown about as a generalization. But I think what we're seeing is the way in which business is structured is actually keeping businesses from accessing different types of aid. So a lot of directors obviously don't want to get themselves into debt unnecessarily. That's sort of by the by. I suppose that's an issue for all companies. But in particular, I think, you know, they, a good chunk of them, and it'll probably come out sort of in the ensuing discussion, they can't access the income support schemes, either for the self-employed or to even furlough themselves, because there's a clash with their director obligations in being able to avail of these schemes. So for them, CBILS was really the only alternative. And I think the frustration, you sort of see about 25 to 30% of our members are saying they're just not eligible. I think what's been difficult is trying to ascertain in a chaotic environment what the reasons for not being eligible are. You have viability issues, and as Christian mentioned, some of the actually responsible sort of SMEs, several who I speak to regularly, they could see it coming, so they'd actually gotten ahead of the CBILS launch and actually applied for an overdraft extension and were turned down just at the same time that the CBILS scheme was getting running. And now they are basically, because they've been turned down for a loan in those early circumstances, they are effectively cannot apply for anything else apart from this new bounce back loan scheme that's been launched.
And if we look at sort of other countries in Europe, how do their various schemes compare?
So I think what you find across Europe, certainly not in America, but America's loan scheme, I would argue, definitely went faster than the UK's in certain respects, between the point of being agreed and actually operational, although it's went out of money very quickly. So that's a consideration as well. But if you look across Europe, you know, I was contacting counterparts at other business groups in other countries to understand, why it was that, you know, directors were falling through so many cracks in particular. And it turns out that that's an issue with how previous tax policy has been linked to employment status. Those tax advantages to setting up as a limited company have eroded from government policy over the last 5 to 10 years. But regardless, because those companies have structured themselves as limited companies, they're not able to avail of any of that relief unless they pay themselves a salary. And a lot of directors don't do it that way. So the issue is that a lot of the other income support, income protection schemes across Europe just catch so many people to begin with. It's just a different system. I would say that taxpayer value is probably not number one in the sort of list of pre-existing priorities. That does mark the UK out in a sort of pre-existing economic system, generally speaking. But I think the loan scheme itself in other countries where they exist, because you have, Germany has the KfW, as I mentioned, Ireland has this, it doesn't really have a traditional of what's called a national promotional bank. But I was looking at some research done by the European Commission last year, and they were looking at all these different national promotional banks, and we don't really have a tradition of that in this country. So the countries that do have that, so you have a loan scheme where effectively banks aren't really being asked to make commercial decisions. They have this history already of being state-backed guarantees that have already been state aid cleared sometime before. So I think it's just not spotlighting the same kind of issue, because the relief schemes are picking up far more people in other countries. I think that's why, not just the fact that the loan scheme is different.
Victoria, I know that you've thought about the impact of EU regulations and the EU state aid rules. From what you've seen and what you've read, have they hampered this?
Well, I think this is a very interesting example of how perhaps the Treasury's particular interpretation or view of state aid rules has very significantly affected the design and implementation of this scheme. So what's important to know is that EU state aid rules do still apply. They haven't been switched off or waived or suspended for these purposes. It's just that it's sort of a different set of rules. So the normal business as usual, the normal economic circumstances rules are not applicable in this case. Instead, it's a different sort of heading that applies in times of serious economic disturbance. And the European Commission published a set of criteria that they saw as being necessary for state aid schemes in member states to adhere to the requirements that, notwithstanding the very extraordinary conditions that we're operating under, you still can't just go around willy-nilly bailing out businesses and throwing money around in ways that distort competition and adversely affect trade between member states, which is the overriding concern of the treaty. And the framework that they published included really quite prescriptive conditions around the viability of businesses to qualify for the loan scheme, the amount that governments could guarantee, and various other things. And it included something that Christian touched on in his piece, I think. Some of the viability conditions were actually quite fiddly to comply with, especially for smaller businesses. There's this expression known as undertakings not in difficulty, which and it has a very precise definition in EU regulation, which for small businesses or startups, particularly actually startups or high growth potential businesses, was just not possible to comply with. So they were automatically outside the scope of the scheme, really for no good reason. So we ended up with a pretty over-engineered design, which the Treasury then said, oh, well, we had to do it this way because of EU rules. Whereas in fact, arguably the EU rules, if you had complied with that very precise framework, you would have automatically been waived through no questions asked. But you could have, and other countries have, and frankly, subsequently the UK has, come up with other designs to put to the Commission saying, come on, can we just be reasonable here? Can we be pragmatic? We think this scheme is also compliant as we've designed it, even though it doesn't meet these exact rigid conditions. And the chances are, arguably, in the current circumstances, the Commission was not going to die in a ditch over these extremely rigid terms. However, why did the Treasury adhere so strictly to this over-engineered design? Potentially they're just very committed to rigidly following bureaucratic rules in the way that many people criticize the Treasury for, generally speaking. Although also arguably, there were some fairly reasonable policy reasons why you would include viability requirements, so that we're not just throwing taxpayers' money away at businesses who frankly were already struggling and weren't going to survive anyway. So that, it's not completely wrong or unfair to have viability conditions, but potentially they did get the balance wrong in the original design. And as Christian has said, subsequent developments have sought to redress the balance there.
Sorry, you can come in there.
Yeah, so I just wanted to dig deeper into this undertaking in difficulty provision. It was interesting. Got a piece over the weekend with the British state aid lawyer who actually drafted the articles a couple of years ago, and he was saying that there never is any intent. It's always the law of unintended consequences with regulation when it's being designed, but there was clearly never an intent to have this UID, as it's colloquially sort of referred to in the trade, so to speak, as a barrier to aid. It was meant to, and you see it interestingly, I have yet to go through the guidance. I don't think it's necessarily in legislation. A lot of the guidance is from the British Business Bank, but if you look at the guidance around the description of other countries' scheme, it's very clear that the purpose of having this undertaking a difficulty threshold or criteria is to stop governments from helping companies that are in need. Of course, the issue with the criteria around UID is that, and this applies if you're older than 3 years, which is why a lot of younger startups who are investing highly to grow, if your accumulated losses sort of basically top your, I think it's sort of half your subscribed share capital, that ratio means you're technically undertaking a difficulty. So it really does penalize companies, particularly young startups who have maybe scaled up after a few years but are still growing and investing, who are primarily or even partly funded by debt. So what you are seeing is I think Victoria sort of put her finger on one of the issues, is it's not really clear to what extent the government have actually lobbied to get this changed. I mean, it was interesting. There are a host of parliamentary questions written now with a sort of holding answer, but even looking at the government's response in the House of Lords a couple of days ago on this question about state aid rules, what have they done to ask for flexibility? it's not clear. It's just the response tends to be, we are bound by the rules of the withdrawal agreement during transition. And the state aid lawyer who drafted those rules thinks that it's actually not that unreasonable to ask for that amendment if it is so singularly affecting British companies, because without wanting to make a generalization about the banks, a lot of the feedback from sort of high growth companies for whom this has been an issue say that basically the banks are, if you think about it, they have to be, the idea of putting the undertaking in difficulty in that temporary legislative framework for state aid that the Commission came out with, it says for the purposes of trying to stop viability from being an issue, it did put in that date of cannot be in financial difficulty as of December 31st, 2019. Of course, that's something that private lenders have jumped on and said, if you don't fulfill the criteria, the ratio, we're not even looking at you. And think about it. I mean, we have some businesses that run events, for example, so they're seasonal in nature. So when you're looking at a financial retrospective or you want the bank to show you what financial history they've been looking at, if they only look for 3 months, as has been the case for some of our members, well, you're going to have peaks and troughs across the year. So at the very least, there's a need for the Commission to provide some guidance if the Treasury can't do it themselves via the British Business Bank, although I don't understand quite why they can't, to say, at least look at the 12-month retrospective, because that's fair. That will sort of deal with some of the viability issue. But, and it's the last thing I would say on the amendment to the framework, the Commission has been constantly amending its own temporary framework, both to sort of provide recognition for the state aid measures, the schemes that countries are notifying to them. Interestingly, I'm not sure all countries are doing the notification that they should. I read an article yesterday saying some Baltic countries have not actually notified the measures that they should. So, but the Commission has generally taken a very flexible attitude to amending it. So the question is does the government feel that because of the transition period terms that it can't influence? That is an issue in and of itself. However, you need to know, most of the people that I speak to in Brussels say there are plenty of routes in, even informally, to get this issue raised. So I think some of the onus is back on the government to say, well, what clarification have they sought to address this issue, because it's so singularly affecting the UK in Brussels.
Would you agree with that, Christian? You're nodding your head.
Yeah, I think Allie and Victoria have hit the nail on the head with the state aid issue, which I found very frustrating to try to put into that article I wrote, because nobody wanted to own it as an issue. So some banks said that it was a matter for the Treasury. Some people in the Treasury said we have no choice but to adhere to it. Some people in the Treasury said it shouldn't be an issue. The British Business Bank took a different view on it. So it was floating around as an area, an obvious obstacle, but nobody was owning it as an issue. And it's extraordinary to me that even now, listening to what Allie just said, there's no clarity on whether the government have asked the Commission to review the way in which they've interpreted it. Because some EU member states have asked the Commission to nod through a change to the rules. And some states have also just chosen not to really apply those rules. So Denmark, France, they've had no issues getting around this. And I appreciate, as Ali says, different European countries have different existing infrastructure for dealing with the way the state interacts with private business. But here in the UK, it seems rather than ask for a change to the rules, we've devised a whole new load of schemes to try and fill in the gaps. And the rules are problematic. So, for example, if you're backed by private equity, and if you have by nature a lot of debt, you're not viable under CBILS. If you have negative retained earnings, as Ali alluded to, you're not viable under CBILS. And this is a lot of companies. And don't forget how many companies in this country that are never in our national conversation make just enough money to cover their costs, to pay their staff, to pay their directors, and maybe reinvest a little bit. But they don't have huge balance sheets, they don't have huge cash reserves, and they can't prove at a moment's notice that they are viable under these rules. So I think it's very problematic. And the other thing that I think has come out of it is that rather than seek to change those rules, the government has just created a lot of other schemes, some of which have been quite effective. For example, the bounce back loan scheme. Now, there will be problems with this down the line. I can guarantee you there will be instances of fraud, etc. But the fact that probably over 100,000 companies have now accessed within a few days cash help up to £50,000 is impressive. And I would hope that that actually clears the runway a bit so that banks can start to look at those mid-sized companies that need 500,000 or £1 million, not the tens of thousands that this new small scheme is allowing for. And banks themselves, it's a very mixed bag. It's all well and good for industry groups to say, look, we've got 60 lenders participating in this scheme. it still counts, I think, probably 70 or 80% of the loans issued are being issued by just 2 banks. I think HSBC and NatWest account for the vast, vast majority of loans issued. And I have seen correspondence from high street banks to people applying for loans coming up with the most creative ways possible to deny them the loan, or even to talk them out of applying. Because if you can talk them out of applying, then you don't have to register the fact that you haven't issued a loan after a successful application was made. So there are still some real problems with the banks, problems at the Treasury with the regulatory approach, problems in the system. If you're one of the 33,000 firms that's got a loan, good for you, and it will help. But I think over 100,000 expressions of interest have been put forward. The process has allowed 60-odd thousand to become formal applications, and of them, 6 or 7 weeks into the scheme, just about half have received a loan. So I don't think that's something to cheer.
I know there must be a lot of businesses at the moment terrified. Victoria, you pointed out an article earlier today that you'd read. I think it was in the Times. I mean, it's likely that a lot of companies are going to be carrying debt, either wholly or partly guaranteed by government, for years to come. The chair of Lloyds Banking Group was quoted today. He said that the government might end up having to take equity in a lot of these companies if they struggle to service the debt. How do you see that situation unwinding, really?
Well, I wish I knew. And then I would probably be a rich woman in the years to come. It's an extra. I mean, in a way, it's entirely understandable that these emergency measures were put in place to allow businesses to have the liquidity and a bit of breathing space to get through this period of shutdown. And that's, we can all see and support that in principle. But we have to now start looking 1 or 2 steps ahead, because all of those businesses that do receive loans are now carrying debt, partly, I think 80 or 90% backed by the government, but the rest of which banks' balance sheets will be exposed to. And, will that have, what effect is that going to have on smaller businesses who are now carrying an extra burden of debt that they hadn't foreseen, as well as trying to carry on through what are going to be very challenging business conditions for the coming months, if not years. And so I think Lord Blackwell was suggesting that government might actually have to end up taking equity stakes in some of these businesses that it has guaranteed loans to if they get into difficulties. I mean, I slightly shudder at that. That seems like a rather undesirable outcome of having government ownership of thousands of businesses across the economy. If at all possible, I would very much prefer a way to deal with this that doesn't involve government taking ownership across thousands of small businesses. In fairness, I think the Bank of England has said that it considers that the capital buffers that banks have built up over the past years are enough to enable them to absorb a large amount of these loans going bad, to the extent that the banks themselves are liable for that, the portion that isn't guaranteed by government. So, because I think the Bank of England was quite worried about banks not continuing to lend in the normal course, because they would be so worried about the exposure that they have on these emergency loans. So I don't have an answer as to how it's going to pan out, but I think it's a quite worrying situation. And yeah, I'm interested to hear the views of Allie and Christian on that one.
Yeah, I mean, it's quite you have to link everything back to, and businesses, most of the emails coming through my inbox, our inbox, are sort of, we don't want to have to be asking about government relief schemes. It's the last thing they want to do. They're as much, if not more so, interested in participating in the conversation about what getting back to work safely means. But, at the end of the day, and I think it raises, what Victoria's alluding to is sort of just a microcosm of an even bigger sort of fundamental, I don't know about moral, but maybe ideological debate we sort of haven't had yet, which is, for as long as the social distancing guidelines remain in place, you are stopping businesses and businesses' suppliers who supply into them, not just, we tend to look at sectors in silos sometimes in government policy making, can't operate. And so the question then becomes, is that just, you know, because of coronavirus pandemic, they have to fold, they are no longer viable, or are we linking it back into those social distancing guidelines, even if we have a good reason for the social distancing guidelines, in which case, if you can make that link, then, you know, I think the conversation about business support has to continue, and why it's very clear, particularly if the Chancellor does, as reported, you know, want to wind down the schemes, obviously probably in a more flexible, tapered approach than some might assume. But a big part of the support mechanism in the absence of those income protection or support schemes is going to be access to finance. And so you can't really shy away from this discussion right now. Interestingly, if the Commission do end up on this specific issue, you know, basically allowing a ratio for the undertaking and difficulty calculation that, you know, looks more at equity rather than just sort of penalizing companies for being debt funded, then maybe that will allow for a different conversation, generally speaking, going forward. I mean, interestingly, just to briefly bring it back to the state aid dimension, we actually have already seen an amendment to that framework that actually changes the undertaking and difficulty provision explicitly, but for European regional and development funding. So about 3 weeks ago, the Commission did, I think under lobbying from some member states who realized that they weren't going to be able to actually disperse finance and funding to SMEs through the ERDF if this UID provision applied. That has effectively been taken out for the ERDF. So there is all the more reason, I think, to not give up on this, because it's going to be an issue that intersects with tapered business support through access to finance as we sort of slowly come out of the lockdown.
I can tell you on Victoria's point about whether the government will end up holding a stake in thousands of businesses, they will. Whether those stakes are worth anything or not is anybody's guess. One mechanism through which they will be taking a stake, I'm sure, is through the new Future Fund scheme, the scheme designed specifically for startups, those that are pre-revenue, pre-profit, who would not be eligible for any kind of loan otherwise. Again, I mentioned that this is a scheme launched to kind of fill the gaps around the other schemes, and it's riddled with problems. I haven't spoken to a single tech entrepreneur or startup entrepreneur who thinks this is a good deal. In fact, the terms of the deal under which they would be able to get some cash are awful. And one of them said to me, you know, this is a substantial, established, you know, in revenue but pre-profit startup. They've said that their lawyers would never allow them or never advise them to accept the terms of the deal that the government is offering to finance them, which would result in a substantial stake. Taken together, the lockdown measures, the loan scheme, the furlough scheme, all the different support schemes, they have frozen economic activity. And I've got to tell you, my fear is that there are plenty of businesses that will not survive the thaw. And when these schemes are unwound, whether it's help with wages or with business rates or rent deferments or mortgage holidays or whatever it is not going to just simply allow businesses across the country to start breathing again and get back to normal. Some businesses in particular sectors, hospitality, tourism, for example, but also just small companies in the personal services sector, will not be able to come back from this. They don't have the cash reserves. They might not be getting the government support. And when you compound that with the fact that the economy itself is going to be riddled with consumer uncertainty and general economic weakness, I'm afraid that when these government schemes are withdrawn, a lot of companies are going to find that they cannot survive without that life support. And it's going to be extremely sad and very challenging on a national level.
Yeah, and I mean, with the furlough scheme, you're going to have hundreds of thousands, millions of people who may not have a job to go back to. We've seen the government talk a lot about easing the lockdown now. How do you think they'll start reducing that furlough scheme and getting people back to work?
It's going to be extremely challenging. I mean, it was quite an extraordinary Whitehall endeavour to get the scheme up and running as they did. And on those first days when people applied for it and it worked, I mean, you know, those things don't happen very often in the history of Whitehall HMRC IT projects. I mean, it was a bit rough and ready. You know, they've just thrown all the money at companies. You know, they haven't taken away the PAYE or anything else. They just didn't have the time or the resources to do that. So, you know, it wasn't perfect, but from the recipient's perspective, pretty effective and quite welcome. You know, an extraordinary measure to do. There are now 6.3 million private sector employees being paid directly by the state, by the taxpayer. And when you try and withdraw that scheme, it's going to make the implementation of it look like a walk in the park, because rowing it back, pulling it back, how do you do it? Sector by sector? Do you reduce the amount the government pays from 80% to 60%? And as soon as you start to do it, the first business that lays people off, and they will, and is able to somehow blame the government for the fact that they are having to make people redundant, you're into a very difficult political environment. And you can bet that Labour, slightly revitalised now with its new leader, and the trade union movement will be the first to condemn the government for letting businesses go to the wall, as they will put it. Extremely sensitive and controversial policy arguments are coming up.
Yeah, Victoria, do you agree with that? How difficult will it be for the government?
It's going to be extremely difficult and painful and politically extremely challenging to build a narrative and sort of explain why these steps to gradually withdraw the support have to happen, because there are going to be lots of horrible, upsetting stories of hardship undoubtedly coming from it. But my concern is that maintaining this support in place could end up not just increasing the debt and all of the associated difficulties and potential tax increases, etc., that will come alongside that, but could end up actually crowding out and suppressing more dynamic economic recovery by businesses that are able to rebuild and thrive, and keeping the businesses that haven't been able to survive the shock and rebuild on artificial life support could actually ultimately be counterproductive for the economy and growth as a whole. And there will, there may come a time, and you would have thought a government with an 80-seat majority in a fairly strong position might well be in a position to pull off the plaster quite quickly and make those hard decisions to really try and make the economy recover more dynamically than just keeping everyone on state support in perpetuity.
Sure. And Allie, it's been, if we look at this sort of psychological element, a lot of people, the majority of people have been largely sheltered from the economic impact of the pandemic so far, with the furlough scheme, with the job retention scheme. It's going to be an extraordinary case when people don't find that their jobs are there, when the retention scheme falls apart. How do you see the government dealing with that?
Yeah, and I think actually that's a good reason for, there is a big part of me, and I'm sure many people, who worry about what the environment's going to be like between employers and employees going back to work. I know everyone is sort of fearful that it's just going to be a minefield, but that's also a reason to get ahead of it. I think we sort of fall sometimes too easily into the trap of saying, the businesses and unions have to be at loggerheads, when in fact, actually, fine, you have some people arguing about whether the unions see this as a sort of supplementary basis for increasing membership. On the other hand, a lot of the employers, it's mostly SME employers who do this, within days, hours even, of the initial lockdown being announced, you had people who do have commercial premises, employers emailing me and saying, we have we've thought about this, we've reconfigured our capacity and how we structure our premises. Do you think this is sufficient? So many employers don't get the look in. And even in my own local paper, it's interesting. And I wondered how much more we're going to see of this once the lockdown is lifted, and how specific the guidance is or isn't going to be. And, a lot of directors generally want flexibility, but they may want more specificity to provide themselves with cover to say, I have done the necessary to comply with making sure the place is safe. But can you, a union can't do that. We don't have formalized collective bargaining in this country and systems the way you do in the Nordic countries and other parts of Europe, where the union, does negotiate with the employer groups on changes to whether it's guidance, pay, etc. We just don't have that in this country, and we can't and we shouldn't be wanting to change into that overnight anyways, even if people do see a need for employees to make sure their voices are heard as decisions are being taken on safety. If you think about the public risk assessment, there's an issue about whether unions are pushing for the government to make companies disclose public risk assessments. There's a huge amount of commercial sensitivity into what goes into there. So I feel like we're that's my biggest concern, is as much is that, that may be a way to mitigate the impact of it being such a hellish time for companies and workers alike. But when I see in my local paper a sort of story reports and after story report of, you know, workers who are contacting the media and telling them, you know, their side of the story, and you never hear about the employers. And we shouldn't accept that has to be the way things go on in the immediate sort of near term. But it really rests on trying to draw as many people into this consultation exercise about how we ease the lockdown, not really having a tight fist around it and saying we can only let so many people in, because then you're going to have a backlash when the guidance does come out around between people who think that it's far too specific or there's not enough flexibility. And the last thing I'd say on that is, you know, that is a politically toxic battle up ahead in the wider sense. But I also think it's that also why, you know, I've been pleasantly surprised to see members of the opposition parties putting forward questions about access to finance for small company directors. I don't think many of them had any comprehension of how small business actually works. You used to hear people talking about anyone who pays themselves in dividends being tax dodgers, and suddenly they realized that a lot of small companies have to do this. Their suppliers make them operate as a limited company for transparency purposes. So I think actually there are some silver linings that we're starting to see, and that's why business groups have to engage with all parties, is to make sure that level of understanding is there before we go off down too many knee-jerk reactions.
Yeah, okay, so what does the experience of this loan scheme tell us about the future development of our own UK state aid law and policy post-Brexit?
Well, for me, it does illustrate a lot of pitfalls associated with the EU state aid system as being, you know, very bureaucratic and costly to operate, and frankly also giving a way for officials in our own system, Treasury officials, etc., to obfuscate what they are actually trying to do and giving them an excuse often for not doing things as well as they could. And so there are lots of reasons, objectively speaking, why we should seize the opportunity of leaving the EU state aid system and try and improve the law and practice around that in our own country. From the EU side, I think it's probably fair to say that their own level playing field is somewhat disintegrating under the current pressures. So it does now seem a little bit ironic to be lectured about a level playing field while, frankly, countries within the 27 don't really seem to be adhering particularly strictly to the rules and frameworks that they are subject to. And I think this is also illustrated why, as a non-member state, still being governed by EU rules and subject to the ultimate oversight and jurisdiction of the European Court of Justice on these questions, it's really got to be untenable. At the moment, there's clear consensus between the EU's institutions, member states, and the UK that we're in extraordinary times, and a lot of things that would not pass muster in normal times can be done, and the Commission will look more kindly upon them. But in the future, it's unlikely that there will be such a consensus on what is and is not compliant uses of state aid on things like infrastructure investment and tax policy. And I frankly don't see why the UK, as an independent country with no input into the rules, should continue to be bound by those rules.
Can I come back?
Yes, yeah, Allie, go.
There's a couple of things I agree with in there, and some I have some questions about. I mean, it's interesting that, you know, and Victoria will know these arguments very well, that in the past, keyword in the past, you know, state aid policy, even regardless of whether one agreed with the overall approach of Theresa May's government to negotiations or not, made it very clear that, you know, the history of British input into driving competition law and state aid law, you know, it was a central focus, and interestingly, on the sort of internal market question. And I have to say, even though these are extraordinary times, and we do see the same kind of internal market scrabbles within the United States at the moment, I would say that it's quite amazing the extent to which the UK has managed to keep all four parts of the sort of devolved country and the UK government together, compared to other countries looking at this where people are going off willy-nilly doing completely different things within a country. But at the same time, if you look at it, the point about having state aid rules is to It's not just about binding industry or binding support to industry, but binding selective advantage to industry. So that's what the level playing field is about. Interestingly, on the export restriction issues that the Commission and the EU are having at the moment, I was on a call yesterday with sort of a conference call webinar with the Trade Commissioner, Phil Hogan, and I actually asked the question, I said, for how much longer is the potential for export restrictions within, never mind externally to third countries, not going to be coordinated and not effectively be a single market? And I think he was a bit tetchy with the question. But, I do think that in some fundamental areas, coronavirus has changed the debate around alignment and divergence. I think you'd be a fool to say it hasn't. In other areas, I think less so. So on the one hand, the state aid binding, the objective is supposed to be, the objectives that the EU has in the spirit of the law is shared by the UK, although I would say that the EU does have reason to. I've never thought that anyone would have any reason to be worried about the UK wanting to go above and beyond what subsidy constraints allowed for until I saw the Conservative Manifesto had a big old section that said, we will leave state aid rules, and then explicitly linked it to, obligating public bodies to buy British, which is not the point of, from a free market perspective, certainly why you want to get rid of state aid controls. So I wouldn't be surprised if in the negotiations where the UK rightly says, we have the same objective, but we're not going to be bound in perpetuity by your decisions, when it may be difficult for us to actually get our voice in the door to, does the undertaking a difficulty exercise, even if it gets amended, show that it's hard to get the UK's singularity reflected in the discussions when the regulations are being drawn up? I think that's a very fair question on some fundamental issues, including and particularly state aid. At the same time, if I were Brussels, I would point to that piece in the Conservative Manifesto and you've said you want to get rid of the rules, basically to subsidize beyond what the constraints currently allow for your own agricultural sector. So we have actually reason to be worried about you subsidizing beyond what the rules provide for, which is never a situation I thought we would be in, where the EU is saying to the UK, sometimes facetiously, sometimes in this situation legitimately, we're worried about you going beyond what the rules currently provide for. So it'll be interesting. I think, most people know that the Commission ask on state aid was pretty audacious. And I think, but for the UK, it needs to show how else it would provide those objectives, and that it's not just trying to get rid of constraints because it wants to subsidize its own industry to high heaven.
Sorry, my dog just barked. Christian, do you want to come in?
I'm not going to attempt to gazump Allie Renison's technical knowledge of EU trade and state aid laws.
Or Victoria's.
Or Victoria's, for that matter. But I'll say this, to bring it back to the CBIL issue, is that taking the government at their word that they won't extend the transition period and that December is the deadline and that Brexit is all go, there will come a time when Treasury officials can no longer do what they like to do, which is to consider the need for some new legislation or new framework in the UK and to defer to the EU's existing rules on it. And in the case of the business interruption loan scheme, which is what they did, they literally cut and pasted the relevant section regarding undertakings in difficulty and state aid into the UK framework, rather than devise a bespoke framework for the UK, which they're going to have to get used to doing. And for as long as the time we're still in the EU, then argue with the Commission about how they can manage it. They just did what they do, which is to defer to the existing EU rules. And the mindset shift required in Whitehall to come out of that approach, once we are no longer bound by these rules and institutions, will be fascinating to observe.
It will indeed. Thank you all for joining us. That was Allie Renison from the Institute of Directors, Christian May, editor of City AM, and Victoria Hewson from the IEA, head of regulatory affairs. Thank you.
Thank you.